The 3 ETF portfolio is a simple, powerful, and effective way to build wealth without the stress of trying to pick the next big stock. And in this video, we're going to dive into the details of a few different types of ETFs, along with a variety of 3 ETF portfolios you can build to help you choose or create one that best fits your goals. So let's not waste any more time and get right to it. First, let's get into what is an ETF. An ETF, or also known as an exchange-traded fund, is just a basket of different investments like stocks, bonds, or commodities that are packaged together into a single fund. And this single fund can be bought and sold on a stock exchange just like an individual stock. Most ETFs will mirror the performance of a specific stock index like the S&P 500, which is composed of the largest 500 stocks in the US, or some will focus on asset classes or specific sectors like energy, technology, and others. Now that you know what an ETF is, let's get into the different types of ETFs and some 3 ETF portfolios. So for these first 2 types of ETFs that we're going to talk about, at least one of them is going to be part of each of the ETF portfolios that we'll be going through, so it's important to understand their purpose. First up is broad market ETFs. Broad market ETFs are funds that give you exposure to a wide variety of industries, companies, and depending on the fund, countries as well. They're called broad market because they cover a broad chunk of the stock market or sometimes the whole entire market. A key feature and what makes these funds a great core holding for a portfolio is their diversification. Since broad market ETFs hold different stocks, which are spread over a variety of industries and sectors, this helps to lower risk compared to being only exposed to one part of the market or a handful of individual stocks. If certain sectors or some companies are being negatively impacted due to the fund's diversified nature, it can help to offset it with this exposure to those other sectors and holdings. And looking over the past, these funds have proven to provide great growth and reliable returns over the long term through good and bad times in the market. Some examples of some broad market ETFs that I like include Vanguard's S&P 500 ETF VU, which tracks the S&P 500, Vanguard's Total Stock Market ETF VTI, which holds all the stocks in the US stock market, and Vanguard's Total Stock Market ETF VT, which holds US and international stocks. These Vanguard funds differ in their holdings, with the most diversified being the fund with the most holdings. These are all examples of great funds, and to give you an idea of how these broad market ETFs can vary, here's a list of some broad market ETFs that you can also look into. The next one is a favorite for those income-seeking investors, and that's going to be dividend ETFs. Dividend ETFs hold stocks that pay dividends, and dividends are part of a company's profit that are paid out to investors. These funds not only offer you consistent income, whether the market is going lower or higher, but they're also more stable and less volatile than broad market ETFs, while still offering you the potential for capital appreciation. This is because many dividend-paying companies have a solid history of stable cash flow and earnings, along with solid financials. Aside from just paying dividend income, they can have differences in their purpose or focus. For example, some dividend ETFs might focus on dividend growth, which would be companies that have a history of increasing their dividend payments every year, or they could focus on higher dividend yields, which would contain companies that pay out larger dividends. A few of my favorite dividend ETFs include SCHD, the Charles Schwab US Dividend Equity ETF, which focuses on high-quality dividend stocks from companies with high yields and consistent dividends. DGROW, the iShares Core Dividend Growth ETF, which is made up of companies with a history of consistently growing their dividends, and then VYM, the Vanguard High Dividend Yield ETF, which is a more diversified fund that invests in companies with a high dividend yield. These all can work well and serve a purpose in the right portfolio, given that they each have their own unique strategies. Here's a list of some other dividend ETFs that you can come back and take a look at later on. So this first ETF portfolio I'm going to be showing you is going to be including both a broad market and dividend ETF. And I'll be getting into the details of this portfolio after talking about the third piece that makes up this portfolio, and that's going to be a growth ETF. These funds hold companies that are expected to have above average growth in their revenues or market share as they're expanding their businesses quickly. Unlike the stability that you'd find with dividend ETFs, These growth ETFs are for investors that are really seeking to maximize the returns of their portfolio. For that reason, these funds tend to suit investors with a higher risk tolerance or a longer investing time horizon. And the companies that are found in growth ETFs are in innovative and emerging industries and sectors like technology, healthcare, and even consumer discretionary. And while these ETFs can be very rewarding, they're more vulnerable to large price movements due to companies failing to meet expectations, times of uncertainty, or downturns and recessions. With that being said, some of my favorite growth ETFs are SCHG, the Charles Schwab US Large Cap Growth ETF, QQQM, the Invesco NASDAQ 100 ETF, and then VUG, the Vanguard Growth ETF. These have all shown great performance over the years and vary a bit in their strategies and holding. Again, here's a list of growth ETFs that you can pause and take a look at later on. Getting into the making of this first portfolio, this first piece is going to be a broad market ETF, and that's because, like we talked about, this is the core holding of our portfolio and it really lays down the foundation for diversification. With something like VU, we're getting exposure to 500 of the largest stocks in the US with a variety of sectors that include both growth and value companies. The next piece is the dividend ETF such as SCHD. The purpose of SCHD here is not only for its great dividend features and benefits, but for its tilt towards value stocks. This adds to the exposure of value through VU, but it's giving us some more diversification in the value holding, which adds a bit more stability and resilience to the portfolio. Last is a growth fund like QQQM, which gives you more opportunity for higher returns in the portfolio with the added growth exposure, which kind of doubles down on some of the growth stocks that a fund that VU already has. And you don't need these exact percentages, you're free to adjust with what you're comfortable with. Now, I do want to mention fund overlap since VU and QQQM have 46% overlap by weight. And this is going to be in these growth stocks, so you're getting a lot more exposure to holdings like Apple, Microsoft, and others by holding these two together. This isn't necessarily a bad thing, but it does invite more volatility and risk by having higher weight in those growth stocks. Just something to be aware of. When it comes to returns, over the past 10 years, you would have gotten annual returns of around 13% with this ETF portfolio. It's a well-performing portfolio, and if you wanted more diversification, I think the addition of one more ETF would do the trick. This next ETF portfolio is going to be more dividend income focused and is going to be incorporating a type of high-yielding dividend ETF, which is called a covered call ETF. A covered call is an option strategy where an investor sells a call option on a stock that they already own with the goal of earning a premium. And the premium received from selling the call option provides the investor with extra income. That's how the strategy works, but as for covered call ETFs, they'll invest in a portfolio of stocks while also selling call options on those holdings in their portfolio. This strategy allows these ETFs to generate higher dividend income, all while still giving you exposure to the underlying stocks in the portfolio, making these type of ETFs appealing for income investors. It's also important to keep in mind that while they can offer great income, they do have limited upside potential. By selling call options, these ETFs cap their potential gains, and for this reason, these type of ETFs will often underperform their underlying assets, especially in bull markets. Here's a list of some covered call ETFs that you can come back and take a look at later. For this first portfolio, the first ETF will be the covered call ETF, which I'm picking JEPQ, which is the JP Morgan NASDAQ Equity Premium Income ETF. The goal of this fund is to deliver monthly distributable income and exposure to the NASDAQ 100 with less volatility. It's had some pretty decent performance the past few years since it's been around, and it currently has a dividend yield of over 11%. So this fund will be the main driver of dividend income in the portfolio. The next part of this fund will incorporate two other dividend ETFs, which in my case would be SCHD and DGROW. SCHD offers great balance between dividend yield and dividend growth along its value holding. DGROW is going to be here to not only offer some dividends as well, but also some opportunities for growth potential. I view DGROW as almost adding a S&P 500 ETF here like VU due to some similar characteristics of having a mix of both value and growth holdings. If we take a look at this 10-year chart, we can see how $10,000 in DGROW and SCHD split performed. with over 10% in annual returns and a dividend of roughly 3% when combined. Not bad at all. Now, since JEPQ is a little less than 3 years old, I couldn't include all three together for a 10-year outlook, but you can see here its performance since its inception, including dividends compared to DGRO and SCHD. This is just to show you an example of a type of dividend portfolio that you can create that offers a nice yield and growth potential. For someone who is strictly focused on income, they may instead prefer to drop DGRO and have 2 covered call ETFs with SCHD, or maybe even have 3 high-yielding funds. This third ETF portfolio is a classic one that's going to take into account 2 different types of ETFs not mentioned so far, with this first one being an international ETF. And international ETFs invest in foreign companies, so this would include any country that's not in the United States. Since the markets outside of the US do not always rise and fall at the same time, having exposure to international markets can help reduce some volatility in your portfolio. This allows you to be able to tap into the growth in developing and emerging markets, along with improving your diversification and spreading your risk. The second ETF in this portfolio is going to be a bond ETF. While much less exciting than others on this list, they do have an important role for a balanced portfolio. Bonds are less sensitive and volatile to fluctuations in the market, and when you combine them with stocks, you can help reduce the risk in your portfolio. With that being said, this portfolio is the classic and original 3-fund portfolio. Its sole purpose is to be a simple solution that gives you exposure to cover the major asset classes by having a US stock market fund, be it S&P 500 or total US stock market, an international fund, and then last, a bond fund. This fund, you could say, is the most diversified portfolio that you'll find on this list, although there are many that will question its performance compared to other modified portfolios. If we allocated 70% towards US stocks through a fund like VU, and then 20% in an international fund like VXUS, and then the remaining 10% in BND, a bond ETF, this would be the performance over the last 10 years with $10,000 invested. Not too bad at all, with annual returns of just around 10% over those 10 years, and of course, by putting a fund other than bonds, more returns could have been possible. And the same could be said for international, but that's besides the point. This fund is really about the diversification and managing portfolio risk while giving you exposure to all of the market. Also, here's a list of different funds for these 2 ETF categories that you can check out. This next ETF portfolio is going to have a small cap ETF, and small cap ETFs invest in small cap companies, which are companies with market capitalizations or market values that fall between 250 million and 2 billion. And one of the main benefits of small caps is their potential for higher growth compared to large cap stocks. Since they have more runway for growth, they can have quick growth, which can equate to big returns for investors. Also, when you own an S&P 500 fund like VU or some other broad market ETFs, you may get little to no exposure at all to small cap stocks, so the addition of them could further diversify your portfolio. And while the growth and diversification can be a great bonus, these funds do carry some risk. These companies are oftentimes much more volatile than large cap companies. So while you can see big gains, you also have a higher risk of declines, especially when markets are rough. With that being said, here's a list of some small cap ETFs that you can look into later on. Now, this next ETF portfolio is going to be a slight spinoff of what you have in the classic 3-fund portfolio. And by that I mean you're still going to have your core foundational holding of a US fund, and you're also going to be keeping the exposure to the international fund. But the third piece here will be a small cap ETF like AVUV. The reason is because there's a lack of exposure to these small cap stocks when you're holding a fund like VU. And rather than holding bonds, regardless of how you may feel about them, this gives you exposure to more stocks and it increases your potential for growth. For example, if we compare a 70-20-10 split of US, international, and bonds to this portfolio, swapping out the bonds for a small cap fund like AVUV. If we look at the performance over the last few years, since AVUV isn't that old, we can see that in a 5-year time period with $10,000 invested, this portfolio would have outpaced the classic 3 fund, and if you went a little heavier in the small cap over the international, the gap would widen. I think a portfolio like this can still satisfy the needs of those who want international exposure, but without the bonds. And this is just one example, but it can be modified to suit your goals. There are many different combinations of 3 ETF portfolios that you can make, and I wanted to give you an example of some different portfolios that you could think about, and of course, you can adjust the allocations to what fits your risk and goals. Also, don't feel limited in adding an additional ETF if you want to expand the diversification of these portfolios or a portfolio combination that you may have in mind. This is about your investing goals and what works best for you. And if you want some ideas for some great ETFs that can be added to your portfolio, be sure to check out this video here. Or if you want to see the one ETF that I'd invest in if I could only choose one, then take a look at this video here. Don't forget to hit the like button and subscribe if you haven't already. I really appreciate you watching, and I'll be seeing you in the next one.